Learning Objective 6. Prepare income statements for a merchandising company using the traditional and the contribution formats. Previously, when we talk about cost classifications, we focus on manufacturing companies. And here, to show the traditional and the contribution income statement, we will use merchandise company as an example, because the income statement of a merchandising company is more straightforward. For traditional format, if you take a look at the left-hand side here, this is the traditional format of income statement for a merchandising company. You've learned in financial accounting class. This is multiple-step income statement. We start from sales minus cost of goods sold, which is expense. You will get gross margin minus expenses, including selling and administrative. You will get net operating income. The traditional approach organizes costs in a functional format. Costs relating to production, administration, and sales are grouped together regardless of the cost behavior. The traditional approach is used primarily for external reporting purposes. But for contribution format, it's primarily used by management. We classify expenses by cost behavior, variable or fixed. We start from sales minus variable expenses. You will get a contribution margin minus fixed expenses. You will get net operating income. Here, contribution margin is the capacity to cover fixed costs from operating the firm. You can see here, for those two different formats, you will get same net operating income. For contribution format, if contribution margin is higher than fixed cost, then there will be profit. Net operating income will be positive. If sales increase 20% from $100,000 to $120,000, then variable expenses will increase 20% as well, because the variable expenses increase as level of activity increase. Contribution margin will be the difference between sales and the variable expenses, which is $48,000. Compared to the original contribution margin increased $8,000. Fixed expenses are constant, $30,000. So net operating income will be $18,000, increased $8,000. Both contribution margin and net operating income increased $8,000. If there is no change in fixed costs, the increase in contribution margin will be the same as increase in net operating profit. In the traditional income statement, there are costs of cost of goods sold, selling expenses, and administrative costs. And let's see what type of costs are they, fixed, variable, or mixed. For cost of goods sold, this is variable. Selling, mixed. Administrative, mixed. Some selling and administrative costs are variable. Some selling and administrative costs are fixed. Let's take a look at a comprehensive example. The Piano Incorporation purchases pianos from large manufacturer and sells them at a retail store. The pianos cost on average $1,507 each from the manufacturer. Mavic Pianos Incorporation sells the pianos to its customers at average price of $2,900 each. The selling and administrative costs which the company incurs in a typical month are presented below. So you have selling costs include advertising, sales salaries and commission, delivery cost, utility, and depreciation for sales facilities. For administrative costs, include executive, insurance, clerical, and depreciation for office equipment. During August, the incorporation sold and delivered 56 pianos. Number 1. Prepare income statement for Mavic Pianos Incorporation for August. Use a traditional format with cost organized by function. Here, for traditional format, using multiple-step income statement, we should start from sales, and we calculate cost goods sold. Here, cost goods sold, each piano, 1,507. And then we minus selling costs and administrative costs. So we can first calculate the cost goods sold. 1,507 multiplied by sold units, 56. So total cost goods sold, $84,392. And then we can calculate selling costs. Selling costs, we add all together here, you'll get a total $22,836. And then administrative costs, we add together, total $20,072. So we can organize them in a table here. For traditional format, we start from sales minus cost goods sold. You will get gross margin. Minus selling and administrative costs. Here, we group all selling expenses together and then get total selling expenses. And group administrative expenses and get a total. So, subtract total selling and administrative expenses from gross margin, and you can get net operating income. This is a positive profit. Number 2, for same information, prepare income statement. Use a contribution format with costs organized by cost behavior. To prepare income statement using the contribution format, we need to classify costs, whether if it's fixed or variable. So let's take a look at those costs. For advertising, it's fixed. For sales salaries and commissions, they contain both fixed part and variable part. 4,793 per month, this is fixed. 5% of sales, it's variable. Delivery of pianos to customers, $59 per piano sold, it's variable. Utilities, $645 per month, this is fixed cost. Depreciation for sales facilities, fixed. Administrative costs, executive salaries, fixed. Insurance, fixed. Clerical, fixed part plus variable part. Depreciation of office equipment, fixed. And one more cost, cost of goods sold. This is variable. With more pianos sold, cost of goods sold will increase. So you can see the classification here. And then we can calculate total variable costs and total fixed costs and organize them in a contribution format for income statement. This is a contribution format income statement. We start from sales, total sales, minus variable expenses. We have cost goods sold. This is 1,007 each piano multiplied by sold pianos, 56. And you will get total here. and then sales commissions, delivery pianos, caloric. And you can calculate total variable expenses. We subtract the total variable expenses from sales, and that's contribution margin, 64,120, and minus all fixed expenses, and we get net operating income, 35,100. This is exactly the same for traditional format income statement here. In summary, to prepare a contribution income statement, we need to decide whether expenses are variable, fixed, or even mixed. For variable expenses, that's variable part. For fixed expenses, fixed part. But for mixed expenses, we need to differentiate variable expenses and fixed expenses. So we can organize total variable expenses and subtract the total variable expenses from sales to get a contribution margin, and then minus total fixed expenses. This is the end of chapter 1.